Bismillahirrahmanirrahim. Hi, Assalamualaikum. We are from Group 4. So today we are going to present about 10 basics of accounting concepts. So my name is Muhammad Nazrin Arman, presenter number 1.
And my name is Alfan Menkar Faizi.
And my name is J. Amir Mifzal.
And my name is Shakir Denis Misafuriza.
And my name is Ryan Yahya Zubaidi.
So for the introduction of 10 basic concepts of accounts is actually in accounting, there are several fundamental concepts or principles that form the foundation of how financial information is recorded, presented, and interpreted. These concepts ensure that financial statements are prepared in a consistent, reliable, and comparable way across time and organizations. So, moving on, number 1, separate entity. So, this definition is a business is treated as separate from its owner. So, personal and business financials must be not be mixed. So, meaning that even if the owner financial and runs the business financial transactions are not made with the owner personal transactions. For the example, if the owner withdraw cash for personal use, it is recorded as a drawings or owner withdrawals in the business book, not as a business expenses. So moving on, number 2, going concern. So definition of this is a business is a sum to a continued operation in the foreseeable future with no intention of closing soon. So, meaning that assets are valued based on their use in the business, not their liquidation or value. For the example, a company that owns a building for operation records its cost or adjusted the value, not the cash it would get if sold tomorrow, because it is a sum the company will keep using. That's all from me.
The other of the basic accounting concept, number 3, is money measurement. The definition of money measurement is only transaction that can be measured in monetary terms are recorded. The example that we can see is like employee skills are valuable but not recorded in the book, or such as like the other uh, part is like staff has an accident or whatsoever, like that. And another of the basic accounting concept is objectivity. The definition of objectivity is records should be based on verifiable evidence, not personal opinion. The example of the objectivity is an invoice for 500 is proof of purchase, not an estimate. And that's all from me. Thank you.
So moving forward to the next one is accrual. Accrual by the meaning is for the income and expenses when they are earned and incurred, even when the company use cash and not been received or paid yet. This method gives a more accurate picture of a company financial performance because it matches revenue with the cost related to them within the same period. For example, when the Adidas sells shoes to a retailer in December but receive the money at the January, the revenue is still recorded in the December since it was when the scale actually happened. So for the number 6 is the materiality. It means focusing on financial information that is important enough to influence decision. Small or easy details can be ignored if they don't affect the all understanding of the company financial situation. For example, when the Adidas company buy a paper tips for the office, the cost is too small to matter, so it's recorded as an expenses right away instead of being checked in the detail for the company. So for the next one, I will pass to my friend Shaki.
And for my part, I will explaining two important accounting concepts, which are consistency and comparability. First, let's look at the consistency concept. This concept means that a business should apply the same accounting methods and principle from one year to another. The main purpose is to make sure that financial information remains reliable and comparable over time. For example, if a company records depreciation using the straight line method this year, it should continue using the same method next year, unless there is a strong and valid reason to change. Next, the comparability concept. Comparability allows financial information to be compared across different years and also between different companies. This concept is very important because it helps stakeholders such as investors, managers, or creditors to evaluate performance and make better decisions. In simple words, consistency creates reliability while comparability makes the information useful for decision making. This is for all for my part. Thank you. Next, I will pass to my friend Ryan.
Okay, so moving on to prudence. This concept simply means that accountants should always be careful and realistic. We shouldn't record profits until they're certain, but we should record possible losses as soon as they're expected. For example, if a customer might not pay $100,000 debt, we record that as a doubtful debt early. But if we think we might earn profit next month, we don't record it yet. So in short, prudence helps prevent businesses from looking richer than they actually are. Now, moving on to historical costs, this concept means that we record assets at their original purchase price, not at what they're worth today. So, for example, if a company bought a land for $100,000 10 years ago, it stays recorded at $100,000. Even if its market value rises to $500,000 today, the purpose is to keep financial statements objective and consistent since purchase prices are based on actual evidence like receipts or invoices. So to sum up, prudence keeps us realistic and historical cost keeps us reliable. That's all for me.
So